Hello everyone, welcome to free crash course for competitive exams held by VIRAT HINDUSTAN SANGHAM in association with Manifest IAS Bengaluru. This program is inspired by Dr. Subramanian SWAMY and it was inaugurated in the month of January. It is convened by Sri Ravishankar sir, State Education Convener for VHS Karnataka and also President of Good Neighbors India NGO. So I am the chief mentor of your program. I have the experience of mentoring civil service aspirants for past 5 years. So you can watch this program online on the YouTube channel of VIRAT HINDUSTAN SANGHAM and also on the YouTube channel of Udaya News Karnataka. For further mentoring, any guidance, related queries, any doubts regarding any competitive exams, you can join our Telegram channel, VHS Education Forum, also by clicking the link, right? Okay. So we are negotiating the economy part of your syllabus and what to expect out of these classes. For seniors, it's a revision program, and for freshers, it's a concept clearing classes. So you'll get the gist of the entire syllabus. So we are in the economy section and we are the primary source for your economy is the book Sriram Srirangam. I'll be teaching from this book. This book is more than sufficient for getting hold of your Indian economy. So we were dealing with banking system in India, banking system. So I told you bank is a financial intermediary. So it deals with the assets and liabilities, right? It is a financial intermediary. So there was one amendment with respect to the Banking Act. There was one amendment with respect to the Banking Act. So you have Banking Regulation Act 1949. That is when the banking regulation starts in India. Banking, the regulation of banks starts in India via the Banking Regulation Act 1949. That is the primary act. RBA Act 1934. So this act was amended in 2017. What was the amendment all about? RBI was given more powers. RBI was given more powers to issue directions to the bank for initiating recovery proceedings. See, earlier it was at the prerogative of the banks. Banks, if they want, they can issue the directions they can carry out the operations to recover the loan. RBI role was very minimum, but via this act, RBI as the proper to give directions to the bank that you have to initiate proceedings to recover the loans, right? So why in 2017? Because by 2017 there were many cases. This ILFS case and also your Diwan Housing for DHFL case. So many banks went bankrupt. There was lot of issues. So there was no disclosure and the non-performing assets were also increasing. Because of all these reasons, RBI was empowered to give more directions to initiate recovery proceedings under what code? Under Insolvency and Bankruptcy Code 2016, right? So 3 years of IBC. So Insolvency Bankruptcy Code has come into existence from past 3 years. So what are the achievements in 3 years? Faster recovery of stressed assets. Stressed asset, I told you what is a stressed asset. So recovery has been faster, and earlier if a loan is defaulted, it used to take 5 years, 10 years, 15 years. Now within years, the money is recovered by the banks. That is one advantage. And quicker resolution timelines. See, according to Insolvency and Bankruptcy Code, the standard timeline is 180 days. There is provision of extra 90 days. But within 180 days, the loan should be recovered. That is a standard procedure, right? So quicker resolution timelines, and also recovery, I told you yesterday, recovery through the IBC was 70,000 crores. 70,000 crores. This is a huge number. So there is confidence in the market, there is confidence in the banking system, there is confidence in the investors that if something goes wrong, IBC is there to save them. So it gives rise to credit discipline. There is good loan portfolio or loan market in India is directed. Nobody can cheat the banks now, right? So credit discipline is ensured. And also shift to creditor. Earlier, it was the courts. Courts used to rule whether the company can be taken over, whether the company can be dissolved. Debtor sala madironu, if he is owning a company, what measures should be taken with respect to that company? It was decided by the courts. Now it is the creditor, committee of creditors. So all the persons who have given loans to that particular company, they can come as a committee, COC. They can come together as a committee and give directions to the IP, insolvency professional, to recover the loan. So the control is with creditor. Creditor is a lender who has given the loan, right? Next, it has ensured credit discipline. Credit discipline. So discipline in giving credit, recovering credit. So there is good credit discipline. So these are the positives of insolvency and bankruptcy code. Now you have twin balance sheet challenge. Twin balance sheet. See, twin balance sheet challenge means what? See, banks give loans to the corporate companies. They don't repay. So the balance sheet. So balance sheet means what? Account. The account of the companies will also go down. Balance sheet, they show loss. So they don't repay the banks. So in turn, banks' balance sheet will also go down. Companies' balance sheet will show loss first, and in turn, banks' balance sheet will also show losses. So this is what, just by giving loan to the company, they show the losses and banks show the losses. It is a circular chain. So that is called the twin balance sheet challenge. Corporate balance sheet goes down, bank balance sheet also goes down because of non-payment. So over borrowed. Why? Because this corporate over borrowed and are not able to repay. That is why the balance sheet goes down and no repayment. So it leads to non-performing assets. Non-performing assets, balance sheet goes down. So this holds the private investment. Twin balance sheet challenge holds the private investment. When the balance sheet of the company, when the balance sheet of the banks are not good, private investors will hesitate to invest in the market. They won't invest either in the banks or the companies. So it leads to holding of private investment, and also whatever the investors who have invested in the company, their investment is also stuck because the company is not repaying. So that is one thing. Then IBC, this needs when twin balance sheet challenge happens, so it should be corrected via IBC. Both the balance sheets have shown low losses, so it should be corrected via insolvency and bankruptcy code, right? And also, when balance sheets go wrong, there should be recapitalization. Hanavanna ತುಂಬಬೇಕು ಬ್ಯಾಂಕರಿಗೆ. So there is a need for recapitalization. So also there is public sector reconstruction company. So what is public sector reconstruction company? So when the balance sheets of both the banks and the companies go wrong or show losses. So what happens? Under IBC, asset reconstruction company will come. They are going to try to revive the company. So in turn, if it is not a private asset reconstruction company, if the government itself builds a company to reconstruct the asset, that is called public sector reconstruction company. So we have this PARA, Public Asset Reconstruction Authority. So Public Sector Asset Rehabilitation Agency, PARA. So just like it is just a asset reconstruction company, it is called as a bad bank. Bad bank means what? See, whatever the bad loans or the bad assets are there, bad assets which are not repaying to the banks. So those assets will be taken over, will be taken out of the balance sheet. Bank balance sheet, this asset is pledged. So what this authority does, it is going to take that asset out of the balance sheet of the bank, and it is going to take it upon itself and try to revive that company. Try to revive that asset. So asset means it can be a company. So this, if it is done by the government agency, it is called Public Sector Asset Rehabilitation Agency. So there is a recommendation to set up this agency. Who recommended? Economic Survey 2016-17 recommended to set up the Public Sector Asset Rehabilitation Agency, para. So it solves the NPAs, non-performing assets, it solves. So it is a special purpose vehicle. Special purpose vehicle. What do you mean by special purpose vehicle? So it is not an authority, rather it is a constituted for special purpose. Special purpose, for example, which are the special purpose vehicles? You have your BWSSV, Bangalore Water Supply Board, that is a special purpose vehicle. BDA is a special purpose. So they focus on some special work. So this is also special work, that is take the bad assets and revive it, right? Okay. So they issue government bonds and buy big bad loans. So what they do, see there is a bad asset in the balance sheet of the bank. So what they do, they will issue the government bonds. Who issues? Para. Para issues government bonds to the banks. Banks take these bonds and give the asset. In turn, they don't give money. Give the asset to this para authority. So this special purpose vehicle, it issues government bonds and buys big bad loans of PSBs. Bad loans now. Suppose Vijay Mallya has cheated. He has cheated. So that is shown as a bad asset in the balance sheet of the bank. So what this para does, para is going to issue government bonds. So bank is simply they are not going to give the asset to this agency. So they will have some, they need their recovery, right? They need money. So which is gone bad. So they are going to take the government bonds from para and give this asset back to the para. So para in turn will, so bad loans na tagondi, it is going to revive. So it relieves the banks of NPAs. What does it do? Asset bank in the ache banbudutala. So bank the NPAs will go down and it will settle the issue faster. Later, how para revives the authority, that is revives the company, that is not our concern. But it is outside the bank's balance sheet. So banks are saved, right? So this will settle the issue faster and it will settle the issue independently. So there is no intervention, government intervention. This is an autonomous body, government intervention illa. So independently it is going to settle the issue and it is called the country's bad bank. Country's bad bank, right? So PJ Nayak committee, with respect to PJ Nayak committee, PJ Nayak committee has given certain recommendations with respect to public sector banks. How to revive the public sector banks. So PJ Nayak committee, what are the recommendations? One is, in the banks, public sector banks, government it is owning more than 50%. Government is the owner of the public sector banks. So what PJ Nayak committee says, government holding should be below 50%. Below 50%. Government should divest these banks. Government should get out of these banks. That is what the PJ Nayak committee says. So and also it says that board appointment should be professionalized. Board appointment. What board? Bank. Every bank has a board of directors, right? That appointment should not be political. Political interest in the appointments madbadu. Rather, the appointment should be made via professional appointment. The appointment should be professionalized. Whether that person being appointed is eligible, what is his qualifications? So how does he contribute to the well-being of the bank? How does he is going to innovate in the bank? So based on all these objective criteria, that is based on his merit, that person should be appointed to the bank board. That is what PJ Nayak committee says. And also it says that the board members should have fixed term. Chairman or board members should have fixed term. Why fixed term? Because if you frequently remove the members, if you frequently keep changing the board members, they won't be able to contribute to the functioning of the bank. So there should be fixed term. This is also said by PJ Nayak committee. Next, you have bank consolidation. I told you. What is bank consolidation? Merger of the banks, merger of many banks into single bank. So bank mergers, there is lot of bank mergers since 1991. SBI is there. 2 years back, there was 2 to 3 years back, 10 public sector banks were merged into 4. This Corporation Bank, Canara Bank, Syndicate Bank, all these banks, right? So they were merged into 4 entities. So since 1991, this has been said. So bank consolidation is said by is recommended by M. Narasimham Committee. Narasimham Committee, I told you there are two committees, 1991, 1996 or 1997. So, these consolidation is recommended by M. Narasimham Committee, and also P.J. Nayak Committee has also recommended bank consolidation. Both these committees have recommended banks consolidation. And reasons, what are the reasons for bank consolidation? Reasons, so I told you in the earlier class, reasons means it is going to create one big entity instead of many entities, one big bank will come. It is going to increase the market capitalization, that bank will become strong. It is going to reduce the expenditure on infrastructure. Infrastructure expenditure will be less, employee salaries will become less. So the bank will have more strength. So more market capitalization, more accounts will be opened in one single bank. So also because of consolidation, what happens in the world arena, across the world, there will be one big bank from India. So till now there was no banks among the biggest banks. So when we consolidate our SBI, if we consolidate, it will become one of the biggest banks in the world, right? That is also there, and it will help deal with the NPAs. When the bank becomes stronger, non-performing assets adrunu, they will be able to withstand. So all these benefits are there, right, by bank consolidation. These are the reasons as well as the benefits. SBI is consolidated, I have told you already. And criticism, there is criticism of bank consolidation. What bank consolidation criticism? One is the work culture. The work culture of different banks are different. You merge Canara Bank with Syndicate Bank. The work culture of Canara Bank is different from Syndicate Bank. How can you merge that? And second point, see, because of bank consolidation, many employees are given VRS, right? It will lead to loss of employment, and infrastructure cost to salary cost are all reduced. Many people will lose employment, right? And also one single bank, if something, see, I told you one single bank will be able to withstand the economic crisis. If something happens, financial crisis happens, one big bank will be able to withstand. Suppose, let us say that bank itself will fail. That big bank itself will fail. Entire bank system will fail. It will lead to economic crisis, recession. So that is what happened in 2008, Lehman crisis, Lehman Brothers financial crisis. So if we have multiple banks, even if one bank fails, there are other banks which will be able to balance. And also, if there are multiple banks, government can borrow from multiple banks. If there is one bank, if they refuse to give money to the bank, give money to the government, it will be problematic. And also, if there is only one bank, what happens? Monopolistic. There will be no competition, right? Monopolistic tendency will arise. So all these are the criticism with respect to bank consolidation, right? Okay. Next, we will move to Indra scheme 2015. So what is Indra scheme? I have told you it is recapitalization. So 2015, this was so with respect to what? NPA burden public sector banks. This Indra scheme, it is with respect to non-performing asset burden, whichever I told you, 75% of the loan bank accounts are with public sector banks. And also, if there are 100 rupees of non-performing assets, 90 rupees of non-performing assets is with the public sector banks, right? Because of all this, to revive the public sector bank, Indra scheme, recapitalization scheme is enacted. So what? There are 7 points. Oh, sorry. Yes, there are 7 points under this scheme. What is the 7 points? One is it deals with the appointments. So actually, this actually is with respect to P.J. Nayak Committee recommendations. P.J. Nayak Committee recommendation. This is not Indra Dhanush ends here. So P.J. Nayak Committee recommendations, it gives how to revive the banks. These are the recommendations it is given. What are the recommendations? 1. Appointment should be transparent. So whoever the board members, chairman members, whoever you appoint, managers, it should be transparent. There should be no corruption. Only eligible people should be appointed. That is the first point. Then he says there should be a bank boards bureau. Bank boards bureau. That bureau should look into the functioning of the bank. It should manage the bank. Andre, now it is MD of some, this will be there, right? So this MD who is appointed, it is appointed by the government. No, rather PJNI committee says instead of government there should be bank boards bureau. So all public sector banks, MD, board directors, everybody should be appointed by this authority, and it should act as a regulator. It should manage the affairs of the bank. So banks board bureau is proposed to be set up by PJNI committee, and it also speaks about capitalization. If the banks go loss, how to capitalize them, how to put money into the banks. That is also spoken by the PJ Nayak committee. Next, it also speaks about consolidation. I told you, PJ Nayak committee also speaks about consolidate merger of banks, and also it says government should not interfere. Government should not interfere in the functioning of the banks. That is also said by this PJ Nayak committee. Then it says there should be accountability. Accountability. Suppose a manager sanctions the loans for the banks. He sanctions loans for the bank. So when he sanctions, if the loan goes bad, if the document is not verified properly, he should be responsible. He should take the responsibility why he did not verify the documents properly, right? So there should be proper accountability, and also PJNI committee says there should be proper governance reforms. Governance, bank ali, how the bank governance is carried out. That governance reforms should be there in the bank. So these 7 points are given by the PJNI committee with respect to how to revive the public sector banks, right? Next, Bank Boards Bureau. I told you what is Bank Boards Bureau. It is an autonomous body. It is an autonomous. It has no connection with the government, right? Bank Boards Bureau. Next, it deals with the appointment of major post, high level posts in the banks is carried out by the Banks Board Bureau, and also it deals with the capital issues, how to raise the capital, how to pump capital into the banks if the banks go into losses, where to raise the capital, right? How to manage the capital. Everything would be decided by the Bank Boards Bureau, and also it deals with the consolidation. How to consolidate the bank, which all banks needs to be merged. Everything would be dealt by the Bank Boards Bureau. So it is recommended by PJ Nayak committee. I have already told you. Then why Bank Boards Bureau should be there? I told you with respect to the risk. With respect to risk for a bank, I told you according to Basel III norms. Basel III norms, there are 3 types of risk. One is capital risk, second is market risk, third is operational risk, right? All these three risks can be managed by the Banks Boards Bureau. That is the advantage, right? Next, differentiated banking. So what is differentiated banking? So it is actually, you have to understand this concept with respect to universal banking. Universal banking andre one bank will be there. It will give every kind of product, pension product, insurance product, saving product, fixed deposit, right, loans, everything, internet banking, everything will be given by one under universal banking. Whereas differentiated andre each product, each bank will concentrate on only one product, right? If some bank is there, if it is focusing on infrastructure, it will focus only on infrastructure. It will not worry about any other sector. If a bank worries only about agriculture, it will only worry about agriculture. Your IFCO bank, it worries about agriculture. Your IDBI, it worries about infrastructure. So those are the differentiated banks. So one bank, one sector, right? Differentiated banking, that is the aim. Then clients, who are the clients? Different sectors are the clients. Transport sector, industrial sector, yes, corporate sector, agricultural sector, logistics sector. There are many sectors who are the clients for these banks. So what is the mode of banking? So who recommend this? It is recommended by the Nachiket More Committee. Differentiated banking is recommended by Nachiket More Committee, right? So as I told, it focuses on specific segment. As I told, it focuses on just specific segments of the economy, right? What are the modes of functioning? It functions via various various channels. It functions via various channels, urban, rural, and also tier 1 cities, tier 2 cities. It also, some banks function online also, some bank function offline also. These are the modes. Then RBI promotes these differentiate banks. So these banks, they are specialized in their own sector. Yav sector mele they concentrate, they will ensure that they become experts in that, right? So RBI promotes this differentiated banking. Now we will talk about the small finance banks. See, this is a new concept, small financial banks, small financial bank. So these are actually scheduled commercial banks. Small financial banks are under the Schedule 2 of the RBI Act, and they are commercial banks. I have told you what is a commercial bank. So these are actually small units. Andre small units andre banks small agiralla. They focus on small units, small industries, small scale agriculture, small scale handicrafts, right? Small scale infrastructure. It is going to focus on small units. So these are actually set up by the Companies Act. Companies Act 2013 prakara, these small financial banks are set up, right? So these focus on, these are private banks. These are not public banks. Small finance banks are actually private banks, right? So ideally, actually, to start a small finance bank, you should have minimum 100 crore capital. To start a small finance bank, you should have minimum 100 crore worth of capital. So illi both CRR, cash reserve ratio, and statutory liquidity ratio, both are applicable to small financial banks. Small financial bank is CRR, SLR, both are applicable, and they should lend for 75% of their assets should be, or their money should go for priority sector. I told you what are the priority sectors. 70, if 100 rupees idre, 75 rupees should go to priority sector for small financial banks. Next, you have what are the services provided. So they also focus on services. They also focus on service sector, not only manufacture sector. The small financial banks also focus on service sector, right? For and also services. What are the services provided by the small finance bank? What services it provides? One is, it may provide insurance, it may provide pension, it may provide demand deposit, it may provide fixed deposit, all these products. Health insurance, it may provide, bike insurance. So it may provide multiple services. So also RBI on tap licensing. So this, if you want to start a small, this small finance bank, actually you can start it by on tap licensing. That is on tap licensing, right? It is simple licensing. To start the bank, you don't need any cumbersome procedure. Just by simple licensing, you can start the small finance bank, right? Okay. So who recommended it? Raghuram Rajanji. In 2009, he publishes a report. 2009, Raghuram Rajan publishes a report. The report name is 100 Small Steps Report. Under 100 Small Step Report, this report recommends the starting or the beginning of small financial banks. 100 Small Step Report recommended by Raghuram Rajanji speaks about the small finance bank. Next, you have the payments bank. Payments bank. See, you have to small finance. You should know small finance. The name itself will speak about financing the small units, right? Similarly, payment banks. It deals with the payments. It deals with the payments. Like suppose you are here, you want to send money to Chennai. Via this payment bank, you can send money to Chennai, to anyone. And also, these payment banks focus upon this digital products, yadu UPI, BMAP, all these payment banks. So it deals with the payment from one person to another. Also, it deals with the utility bill payment, electricity bill payment, gas bill payment, insurance bill, all these things. It only deals with the payment. So who recommends this payment banks? It is recommended by Nachiket More Committee. Nachiket More Committee speaks about the payment bank. So idralli payment banks alli actually there is a deposit limit. So you can deposit only 1 lakh rupees. More than 1 lakh rupees you cannot deposit in the payment banks, right? So that is one point. And also illi these payment banks won't give any loans. Payment banks won't give any loans, right? And also payment banks can issue debit card but not credit card. They cannot issue credit card, right? So these are the things. So illi check kuda kodadilla avaru. There is no provision of check. No check, no credit card, only debit card, ATM card. They will give only 1 lakh you can deposit in the payment bank. What are the activities? One is DD, demand draft. You know what is a DD? So also demand draft is given and also demand deposit. Demand deposit in the saving bank and current account. So whenever you demand, the money is available to you. That is demand deposit is available in payment banks. And also illi NRIs cannot deposit. Payment banks alli NRIs cannot keep their money. So payment martini anta foreign in the India madakagala, right? So no NRI remittances. NRIs cannot send money via this payment bank. Most important point. Next, these are provided by deposit insurance. Deposit insurance, I told you, deposit insurance. You keep money, the bank will go Diwali, so your deposit is lost. So if the banks actually insure in the Deposit Insurance Corporation, Deposit Insurance Corporation, DICGC, it is a part of RBI, right? So this payment bank money, whatever you keep, it is protected under the DICGC. Next, there is no fixed deposit. So though savings bank is there, current account is there, there is no provision for fixed deposit in this, right? And no lending. As I told you, these payment banks would not give any loans, right? Then they give debit card. They give debit card, but also they are eligible for, they are liable just like the small financial bank. They also have to maintain the cash reserve ratio. Small finance bank have to maintain the cash reserve ratio, and also they have to keep 75% of their money in SLR. 75% of their assets in SLR, right? So normal banks, commercial banks, just 15%. The payment banks, 75% they have to keep with the RBI, right? Next, they have to also maintain the capital adequacy ratio. Minimum capital should be there. They are liable for capital norms, CRAR, that is capital adequacy ratio they have to maintain. Also, they give various products. What are the products? Pension product, saving product, insurance product, right? So many products is given by the payment banks. Okay. So 25% of the branches of these payment banks should be in rural areas. That is one condition. 25% of the branches should be there in rural areas, right? Next, they are registered just like the small finance bank. The payment banks are also registered under the Companies Act 2013. So, and what are the objectives? What are objectives of the bank? It is, as I told, bill payment. Next is sending payment from one place to other place, and also small savings, that is up to 1 lakh. These are the objectives, right? So these are the objectives. And also, see, actually big banks, if somebody doesn't want to invest in the big bank, they don't want to keep in the big bank, so they can just keep the money in the payment bank. These are some of the objectives, right? So they don't carry out any lending. One more objective is this: whatever the money is in the payment bank, they can be utilized by the government for borrowing. That provision is also there, right? Next, you have India Post Payment Bank. So this payment bank actually private. So here small finance bank actually they are private, whereas payment bank can be both private and public. Which is the public entity? It is the India Post Payment Bank. India Post Payment Bank is there, right? So who recommended it? India Post Payment Bank start ಮಾಡಬೇಕು ಅಂತ who recommended it? It was recommended by TSR Subramanian Committee. TSR Subramanian Committee recommended the beginning of the India Post Payment Bank, right? It is a public limited company. It is a public limited company. 100% of the assets is owned by the government. 100% is owned by the government. it started its functioning in 2018. 2018, it starts the functioning. It has 4 aims. India Post Payment Banks has 4 aims. The first aim is to promote financial literacy. Financial literacy. Andre, today about the finances, the poor people, the illiterate do not have any information. So India Post Payment Bank actually promotes financial literacy, banking literacy, the benefits of banking, everything they are going to promote. And the second aim is to carry out the payment activities. I told you, bill payment, gas payment, all those payments, and sending payment from one person to another, paying for a commercial enterprise, all these things. Commercial, you buy some goods, you can pay via payment banks. All these things can be done via payment banks. Then inclusion, all sections of the society should be included. Poor, rich, upper caste, lower caste, old age, young age, women, men, urban, rural, all sections of the society should be included in the payment bank. That is one thing. Then there should be easy access. Easy access should be there for the banking services. There should be easy access. There should be no hassle. This is also one of the aim of the payment banks, right? Next, we will speak about regional rural banks. Very important. Regional rural banks. Regional rural banks, actually it was started in 1976. It is a statutory organization. Statutory organization by Rba Act 1976. It was started by Rba Act. Regional rural banks, andre, it functions, as the name suggests, it functions in the rural areas. It functions in the rural area. So it functions in the rural areas, and it carries government operations. Where these rural regional banks are, where do they come in handy? Suppose a Manrega payments, direct benefit transfer, Pahal Yojana, all these yojanas, pension, old age pension, health benefit. See, all these government schemes can be implemented via the regional rural banks, right? Government operations can be implemented via the regional rural banks, right? So it is a scheduled commercial bank. Regional rural banks are scheduled commercial banks, right? So they provide various banking facilities. I told you, whatever the banking facilities, they are provided by these regional rural banks. Actually, the ownership of these regional rural banks is divided between the 3 entities. One is central government, state government, and the third is the promoter bank. So regional rural bank, they cannot exist independently. Some bank should promote it. Andre SBI should promote one regional rural bank. Maximum regional rural banks are promoted by SBI. More than 10 banks are promoted by SBI, regional rural bank, right? So 50% of the ownership of regional rural bank will be with the central government. 15% of the ownership of the regional rural bank will be with the state government. 35% of the ownership will be with the promoter bank. Whichever bank promotes, Canara Bank, SBI, Syndicate Bank, whoever promotes, 35% of the ownership will be with them. Next, here also there is provision of consolidation. There are many banks. So here regional rural banks, they say regional rural banks should also be consolidated. They should be merged and form a one big bank, right? So they float shares. These regional rural banks float shares. So floating shares, what do you mean by floating shares? So floating shares means, so the interest rate of the shares varies. Interest rate of the share vary. That is a floating share. So these regional rural bank actually float shares. Why do they float shares? In order to raise capital. There, however, the interest rate of the share or the money which you get from the share, actually it floats. It is not fixed. So floating shares are given by the regional rural banks, and there is a need for recapitalization also. Regional rural banks, many banks have gone into losses. There is need for recapitalization of the regional rural banks. Next, you have the Mudra Bank. Mudra Bank, Micro Unit Development and Reconstruction Refinancing Agency. Micro Unit Development and Refinancing Agency. What does this Mudra Bank do? So this is a recent phenomena from 2016, 2015, 16. Narendra Modi ji started Pradhan Mantri Mudra Yojana. So microfinance institutions ke in order to lend the loan, in order to lend the money, this Mudra Bank is started. So it gives collateral free loan. There is no security. There is no mortgage of any property. Without any collateral, this Mudra Bank is going to give loans, right? Mudra Bank. So Mudra Bank focuses only on industry, a small scale industry. It doesn't give loan to agricultural sector. This point is important. Mudra Bank doesn't give loan to agricultural sector, and it is a non-NBFC, non-banking financial corporation, non-banking. It doesn't carry out any banking activity, but it is a financial corporation because it gives loans to micro-financial institutions, MFIs, which in turn give loans to SHGs, self-help groups, right? So that is one thing. Next, Mudra Yojana, Pradhan Mantri Mudra Yojana was started in 2016. So this bank is owned by SIDBI, Small Industry Development Board of India, Bureau of India, Bank of India, Small Industry Development Bank of India, SIDBI. SIDBI owns the Mudra Bank, SIDBI, right? Next, what is the responsibility of this Mudra Bank? What is the responsibility? One is it forms the policy of microfinance. How the microfinance should be disbursed. How the microfinance should be given to people. What should be the policy of giving money to self-help groups, right? That policy is discussed by the Mudra Bank. Next, it registers the microfinancial institutions. Microfinance institutions. See, what are these microfinance institutions, Andre? Every bank will float microfinance institutions. Microfinance institution which gives small loans, small amount loans. Who takes these small amount loans? Especially the self-help groups, right? So, the registration of microfinancial institutions are also done by the Mudra Bank, and also it gives ratings. Microfinance institutions, whether they are good, whether they are performing well, the rating is provided by the Mudra Bank. So it also gives last mile solutions. Last mile solutions, Andre. See, there are many areas, many sectors, many places where the banking is not yet reached. Bank facility is not yet available. So in those areas, those sectors, last mile solutions, tribal area, last mile solutions is provided by the Mudra Bank, right? So that is one thing. It also gives credit guarantee. What is credit guarantee? See, microfinance institutions, small banks, they give loan to self-help groups. Let us say it is collateral free. They are not going to take any money for that. But these self-help groups fail to pay money, repay money. Money na repay madadilla. So avaga what happens? This bank will give the money to the microfinancial institutions. So this is the meaning of credit guarantee, right? Credit will be guaranteed. Next, these banks, Mudra banks, operate through microfinancial institutions. I told you. See, here there is Mudra Bank. You have multiple microfinancial institutions, MFIs, right? So, Mudra Bank. So, these MFIs in turn give loan to SHGs, self-help groups, and various sectors. So, this is the structure, right? Okay. So, self-help groups, they are going to give the money, right? And also, it also gives loan to primary credit. It also corporations. So there are primary credit corporations. It are just like banks. In the rural areas, it will be there. PCC, primary credit corporations. They are going to give the loans. Next, who do they focus upon? They focus upon the poor sections. They focus upon the poor sections, majorly the underprivileged sections, right? So this is with respect to the Mudra Bank. Next, you have FDI in banks, foreign direct investment in banks. So what is the foreign direct investment? See, I told you, public sector bank, the foreign direct investment is 20%, right? Private sector bank, the foreign direct investment is 49%, automatic route 75%, under approval route. That is the FDI in banks. Foreign banks, if foreign banks want to come and operate in India, there are multiple ways. One is subsidiary versus branch. Subsidiary means what? See, branch means they are going to set up a branch directly. Foreign bank is directly going to set up a branch in India, their own branch. For example, your Citibank. They set up the branch directly, or else they can start a subsidiary. Subsidiary andre bank XYZ word JP Morgan antidre, JP Morgan is a word bank. So what they do, they are going to start JP Morgan India anta Indian subsidiary na start ಮಾಡ್ತಾರೆ. India. So this Indian subsidiary, what is the difference between a branch office and a Indian subsidiary? Andre Indian subsidiary, there will be Indian management. Indian management will be there. They are more responsible, right? Okay. So the legal status actually, subsidiary is a independent entity. Or actually, though they are linked to the main bank, they are treated as independent entity. Independent banking bank tara treat ಮಾಡ್ತಾರೆ. ಯಾವ್ದನ್ನ subsidiary na. JP Morgan India, independent bank, not linked to, though they are linked, the linkage won't be considered by the regulator authorities. Whereas branch office is not considered a linked entity. It is considered a linked entity, right? It is a branch of the main bank, not a Indian bank anta. So idana Indian bank anta, idana not a Indian bank anta consider ಮಾಡ್ತಾರೆ, right? That is the legal status. So subsidiaries are separate entity. They form a separate entity from the mother bank. So illi whatever the Indian banks ಏನೇನು rules apply ಆಗುತ್ತೆ, subsidiaries ಗೆ it will apply. For a branch office, there is a different kind of rules which is going to apply, right? This is with respect to foreign banks operating in India. Next, you have development banks. See, development banks also called as what? So they are development banks. Andre, what is the meaning? They focus on the development. They focus on the development. What development? They focus on the development of various sectors. They focus on the development of various sectors. What are the sectors? It may be the development of agricultural sector, industry sector, infrastructure sector, tourism sector, medical sector, various sectors, right? Development. So they give long-term capital. See, what happens, the banks actually are asset liability mismatch. So if I keep money in the bank, so what happens, I keep it only for few years, right? Let's say 4 years or 5 years. Whereas these sectors, infrastructure sector, if it has to grow, it takes finance for 20-30 years. So there is asset. The money I am going to give to the bank is a liability on bank, and the loan which the bank gives to the person, to the industry, to the infrastructure sector, it is a liability. So my asset is my liability is 5 years. Their asset of the bank is required for 15 years. So there is mismatch between the asset and liability. In order to curb this mismatch, in order to solve this mismatch, what they do, these development banks give long-term capital. They give long-term capital for 15 years, 20 years, 25 years, extended period. So which are the development banks? There are certain development banks. One is the IDBI, Industrial Development Bank of India. Next, Small Industry Development Bank of India, second bank. Also NABARD, National Agricultural and Rural Development Bank. So that is there. NABARD is a development bank. You have Exim Bank, Export Import Bank of India. That is also a development bank. And also National Housing Bank. National Housing Bank is also a development bank in India. So they focus on industry sector. They focus on agricultural sector. Development of industry sector and agricultural sector is focused upon. So which is the first development bank in India? It is IFCI. First development bank in India is IFCI, Industrial Financial Corporation of India, IFCI. So with respect to development bank, there is recommendation. The recommendation is given by SH Khan Committee. SH Khan Committee gives the recommendations in order to develop the developed banks, right? Okay. This is with respect to the development banks. Next, if we have the concept of cooperative banks. I told you I have given the brief introduction about the cooperative banks. So what is a cooperative bank? See, you have to decode the word itself. And cooperative means to cooperate. Cooperate among whom? Cooperate among the members of the bank. Members of the bank, right? The principle is cooperation. Cooperation. So actual cooperation among the members. So illi actually they for it is a not profit, no profit, no loss, no profit company. So I have written it there. It is a no profit, no loss. It is independent. Right? Focuses on cooperation. So who are the owners of cooperative bank? It is the members. It is the members who are the owners of the cooperative bank. So the principle is the cooperative principle. Cooperative principle you have under Article 19. There is cooperation. Article 43A speaks about cooperative bank. Article 19 speaks about it. And also your the DPSP and also this thing. Right? Recently, 1 year back, Ministry of Cooperation was started by the central government. So that is why it is. So you have with respect to cooperative bank, you have multi-state cooperative bank, state cooperative bank, urban cooperative bank. So there are multiple types of cooperative banks. Now urban cooperative banks are brought under the control of RBI because there was lot of issues. A PMB bank, PMB bank is there. That is one issue, right? Next, cooperative banks, one member, one vote. Every 5 years there will be elections. Board member elections will be there. So every member will vote. So for every member there will be one year annual general body meeting every 1 year. So one member will have one vote. It will not focus on profit. No profit, no loss company. It is a no profit, no loss company. See, these cooperative banks do not give universal banking. They have limited products. Limited products, right? They are not universal banks. They have limited products. So one of the product is agri specialization. They focus on agricultural sector. Cooperative banks focus on agricultural sector to give loans to the fertilizer, to give loans to the machinery, to give loans to buy seed. So many things, right? So agri specialization. So illi urban cooperative banks are also there. Not only rural, it also focuses on urban areas. So you have Bangalore City Cooperative Bank in Bangalore, right? Next, it gives financial help. It gives financial help to the members. Members want loan, they can take the money. Also, it gives financial help to the sector it is focusing upon, right? Cooperative banks generally they don't lend to industry. Industry they are not going to lend. Generally, the main area is agricultural specialization. Industry jasti loan kodala. So this actually is a part of both money market and capital market. Cooperative bank is a part of both money market and capital market. So what is a money market? If the lending business is within 1 year, if you need the money within 1 year, then it is called the money market. If you want to carry out the transactions of money for more than 1 year, then it is called capital market. I have discussed it in the chapter of money market and capital market, right? So this cooperative bank deals both within 1 year and later than 1 year. So it deals with both money market and capital market, right? So it is scheduled. So there are both scheduled banks and non-scheduled banks. Scheduled banks I have discussed. Cooperative banks there can be both scheduled banks as well as non-scheduled banks, right? So they are subject to CRR and SLR. Just like any other commercial bank, cooperative banks are also subject to CRR, cash reserve ratio, and statutory liquidity ratio. Both these things are these banks are subjected to, right? Okay. So then you have the concept of shadow banks. This shadow banks was given concept was given in 2007 by Paul McCulley. Paul McCulley gives the concept of shadow banks in 2007, right? What does this bank? What is this bank? See, it does, see shadow andre, which is not visible. So these are not regulated by the regulators, RBI, SEBI. These authorities are not going to regulate this shadow bank. That is why they are called shadow bank. So illi they do all the functions, but they are all the functions of the bank. Andre taking money, giving loans, pension products, insurance, everything they are going to do. payment, everything they are going to do, but there is no stringent regulation, stringent monitoring illa, right, with respect to these shadow banks. So they give credit, there is credit availability, they give loans, right? And one more concept is there. So they give credit availability, then they are complementary, andre existing banks idiyalla, brick and mortar. Brick and mortar means what? See, there are e-commerce which you buy on the online. Brick and mortar shops andreno, which is actual shop, brick and mortar. Cement matte brick na construct mado brick and mortar shops. So these shadow banks, actually they are mostly online. Brick and mortar banks are also there, but mostly online. So illi there is one more concept called neo banks, NEOBA banks. Neo banks andreno, these are, you can consider this as new age banks. What is this neo bank? They actually do not have any on ground presence. They do not have proper presence, brick and mortar presence. They are online banks. Neo banks are online banks, right? Okay. So these banks, shadow banks are, see, proper banks is SBI, SDFC, ICICI, all these banks. So these banks are actually complementary to them. They are not supplementary. They are not going to take them out of the business, rather add to their business. That is the complementarity function of the shadow banks. Next we have the concept of universal banking in India. Universal banking andre one bank will provide all the facilities. This follows a cafeteria approach. What do you mean by cafeteria approach? It is like going to a coffee shop. You go and sit and sip coffee there. You will get all banking products there. You will get demand deposit, you will get fixed deposit, you will get even the pension, insurance, vehicle insurance, health insurance, life insurance, and also stock market investment, demat account, everything, export, import, credit scripts, everything, NRI bank account, everything is available under the universal banking in India. That is why it is called a universal bank. Right? Okay. So cafeteria approach. So they focus on both retail banking. Retail andre retail sector ge. Retail sector lending. They focus on retail sector, also wholesale sector. Bulk sector also they focus, and also investment banking. See, investment banking is also called as merchant banking. They focus on investments. They are going to give investments into new industries, new areas, new infrastructure. They are going to invest, right? These universal banks also focus on investment banking, and they are commercial bank as well as investment. They also carry out the commercial activities, also investment activities, commercial activities. So taking the money, lending it, all the commercial activity, paying interest, everything of activity is carried out by the universal bank. So in India, all the banks, you take up any bank, ICICI, SDFC, SBI, Canara Bank, any bank you take, most of the banks in India are universal banks, right? So this universal bank, it is recommended by SR Khan Committee and also Narsimham Committee. Universal banks are recommended by SR Khan Committee and your Narsimham Committee. Next, priority sector credit. What are the priority sector? I have already discussed. Agricultural sector, education sector, health sector, weaker section sector, infrastructure, road sector, priority, right? And also small scale industries. All these come under the priority sector, right? So what is now the priority sector? If the bank has 100 rupees, 40 rupees they have to give to the priority sector lending, 40 rupees, 40%, right? So this carries out the redistributive functions. What do you mean by redistributive functions? Redistributive means take the money, take our money, liability, and distribute it to, or take the money from the richer sections and redistribute it to poor sections, right? So this carries out the these banks. Priority sector lending carries out the redistributive functions. Redistribute the money from rich people to poor people, right? It carries out the redistribute, and there are many categories. I told you the categories, like weaker section, agriculture, small scale industry. Those are the categories. There are multiple categories. So they have particular targets. I told you the target. The target is 40%. 40% is the target for priority sector lending. Agriculture, social infrastructure, weaker sections, all these form under the categories of lending under priority sector. These are the sectors, right? Next, you have priority sector lending, even small finance bank and regional rural banks. Regional rural banks and small finance bank, both of them carry out the priority sector lending. Small finance bank, regional rural banks, both of them carry out the priority sector lending. Fine. So here there is concept of priority sector lending certificate. Priority sector lending certificate. What is this priority sector lending certificate? See, some bank, let us say bank A is there, bank B is there, both of them have to invest 40%, 40% in the priority sector, right? So what happens? This bank will invest 50% in the priority sector, whereas this bank will invest just 30% in the priority sector. So this bank has invested, over invested in priority sector, this bank has invested, under invested in the priority sector. So what they do, 40%, whatever the remaining 10%, they can convert it into certificate. That certificate is called priority sector lending certificate. So at the end of the year, financial year, March 31st, what this bank B can do, they can simply take this, buy this priority sector lending certificate. ಈ 10% extra money ಇರುತ್ತಲ್ಲ, instead of going and searching for debtors, ಸಾಲ ಬೇಕಾಗಿರೋನ ಹುಡುಕೊಂಡು ಹೋಗೋ ಬದಲು, what they can do with the 10% of money, they can just buy this priority sector lending certificate from the over given banks. They have over invested banks, right? This is the concept of priority sector lending certificate. Next we have the concept of microfinance. Microfinance, as the name suggests, small finance. Small finance, small scale finance, giving loan to street vendors, giving loan to handicraft industry, giving loan to slum people for various purposes, right? So these, and giving loans to auto rickshaw walas, dabba walas. So all these things come under the giving loan to self-help groups. Self-help groups. All these are the aims of the microfinance. Why microfinance? See, richer people have lot of documentation. They can access all the banks, right? They have the education, whereas poor section, illiterate section, they don't have any access. So in order to provide access to them, microfinance is given. Microfinance is given, right? So, and also why, when you give microfinance to the poor people, it will help them develop. It will help them in their establishing or expanding their industry. It will help them make profit. It will help them invest in education, health and food. So all these, and also it will help them in financial inclusion. They are excluded from the financial sector. It will help them in financial inclusion. It will help in gender equality, gender empowerment, right? So it may help them in promoting exports. Small scale people, they can promote export by taking microfinance. All these are the aims of the microfinance in India. So we have SHE bank linkage program, self-help groups. So one of the example of self-help groups is your Stree Shakti Sangatana in rural areas. So they are a self-help group. So what they do? So self-help group only, there are many types of self-help groups. Agricultural self-help group, a women self-help group, yeah, handicraft self-help group, artisan self-help group, There are many kinds of self-help groups in India, right? Education, health self-help groups. So many self-help groups are there. So these self-help groups, you link to the bank. See, they want money. Self-help groups want money. Because small people, poor people will take loan of what? How much? 2,000, 3,000 rupees. For 2,000, 3,000 rupees, they will not have any collateral. They will not have any collateral. So what they do? They are going to take money from the self-help group. How do this self-help group get the money? They are going to get the money from bank. So in order to link the bank, and also self-help groups get this bank is not going to give money directly. Right? There were a lot of restrictions. So in order to remove those restrictions, there was a program carried out in India. The program is Self-Help Group Bank Linkage Program. Self-Help Group Bank Linkage Program carried out. So there are various types of providers for self-help groups. Microfinance, many types of providers are there. What are the types of providers? Providers of microfinance. You have NBFCs, Cooperative Banks, right? And also this Mudra Bank, NABARD. Yes, and also you have this normal banks itself, SBI, all these banks also provide microfinance. So there are multiple types of providers of microfinance in India. Multiple types of microfinance providers in India. What are the concerns? What are the problems? See, one is banks are hesitant to lend. No matter what program you do, they require documentation. Without documentation, banks are not going to give. The second concern is there is bad repayment. Self-help groups, actually the money they take, they are not going to give back. Some of them, not everybody. That is one problem. And also there is bad credit culture. See, credit culture, whatever the credit they take, the loans accounts are not maintained properly, right? And also the self-help groups cannot provide any collateral. These banks demand collateral, and many of the self-help groups are located in rural areas, whereas the banks are located majorly in urban areas. See, all these are the problems of microfinance or self-help groups in India, right? Next, this microfinancing bandre, there is a committee which gives recommendations with respect to microfinance. That committee is called the Malagam Committee. Malagam Committee gives recommendations with respect to the microfinance in India, right? What does the Malagam Committee say? It outlines the problems in microfinance. Microfinance alli problems ide anta this Malagam Committee outlines. What are the problems? One is there is high interest rate. There is the interest rate is very high in the microfinance. These people take 2,000 rupees loan. If you provide it at 10% interest, 200 rupees they have to give interest. So interest rate is high. Then there is no proper linkage of NBFC MFI. Rather, they say, this Malagam Committee says the NBFCs and microfinance institutions should be linked. These two organizations should be linked is recommended by the Malagam Committee, right? Then these microfinance institutions should focus on small loan. That is one thing. Small loan focus should be done. That is also recommended by Malagam Committee. Then 75% of the loans given by microfinance institution should go for income generation. That is recommendation. Income generation andre you invest the money, that money should lead to generation of income. You give loan to the bank, that loan should lead to income generation. It should lead to some economic activity. Via that economic activity, there should be income generation, so that it becomes self-sustainable. There is no need for providing further loans. So that is they speak about. And also microfinance regulation, it should be done by NABARD anta Malagam Committee says. NABARD should regulate the microfinance anta this Malagam Committee says. and also it speaks about the priority sector lending. Microfinance should provide loans towards priority sector. That is also spoken about by the Malagam Committee. Next you have the last concept of banking in India, bank run. What is bank run? Does the bank run? No. Bank run means actually when the bank fails. When the bank fails, what happens? See, there was an issue of S Bank 2 years back. There was an incident that they had lent money to non-performing assets or weak assets. So what happened? When the report came, RBI imposed certain restrictions on dividend distribution. Immediately, the depositors started withdrawing the money. So, first of all, the bank was weak. When the depositors started withdrawing the money, the share prices fell. So, the bank in turn became bankrupt. So, this is called the bank run. This is a vicious cycle. Initially, the bank will be weakened due to some issue. In the case of S Bank, it was bad lending practices. In turn, it triggers the depositors to withdraw the money. In turn, it will lead to fall in the share of price. In turn, this cycle continues. That is the concept of bank run. Okay. Next, we will speak about the public sector in India. Public sector. So, what is the public sector? Public sector which is established by the government. Which is in the public arena. Right? So, that is what is meant by public sector. It is not private. You can say that. So, role since independence. What is the role of public sector in India since independence? See, when independence happened, actually the private sector was nil. There was very minimum private sector participation. Then what happened? This public sector started the economic growth in India. You name the area, public sector was there. You name telephone, there was there. You name telephone, you have MTNL, BSNL. You name car making industry, Maruti Udyog Limited was there. It was a public sector. You name oil industry, public sector was there. So everywhere there was public sector, including dam construction, including coal production, Coal India Limited. Everywhere it was controlled by the public sector. The economy was controlled by the public sector. You can say public sector laid the foundation of economic growth in India. Without public sector, India wouldn't have been the economic strong power. Today, it is. Right? Next, what are the objectives of public sector? What are the objectives? One is to see, providing employment is one objective. Providing employment is one objective, and also redistribute welfare of the public. Welfare of the public is the second objective, and also 3, to manufacture social goods. To manufacture social goods, that is the third objective, and also give dividend profit to the government. In turn, it will be invested in social sector. That is the objective for public sector, and also to invest in those sectors where private sector is hesitant to invest. So these are the objectives of public sector. So it contributes to the national growth, right? These are the objectives. See, there are 3 types of public sectors in India. 3 types of public sectors in India. The first sector is departmental undertakings. Departmental undertaking. So when there is, what is a departmental undertaking? See, there is president, prime minister and multiple ministers. Multiple ministers will have individual ministry under them, right? Individual ministries will be under them. Under this ministry, there will be multiple departments. Multiple departments. So, if a public sector is managed by one of these departments, then it is called a departmental undertaking, right? So, departmental undertaking alli, see, it is managed by government. Departmental undertaking is, see, one of the example of departmental undertaking is railways. Railways, though it is a ministry, it is called a departmental. It is one of the departments of government, Indian Railways. So it is a departmental undertaking. right? So it is managed by the government, departmental undertaking. Then it is the expenditure. The expenditure of departmental undertaking is counted in the budget. Budget, consolidated fund of India in the Vogutte Duddu. Budget, so the expenditure, the revenue it comes under the purview of budget, right? And the management is under public government control. The management of departmental undertaking is government control. And also, what is the role of the departmental undertaking? It is to provide services to the public. Provide services to the public. The best example is Indian Railways, right? Then you have the concept of statutory corporations. Statutory corporations. So what is a statutory corporation? That corporation which is started by a act of the parliament. Act of the parliament. If a corporation is started, then it is a statutory corporation, right? That corporation which is based on an act of the parliament, right? That is a statutory corporation. So next you have companies. Companies is the third type of public sector undertaking. These companies are registered under Companies Act. Companies Act. So these are the three types of public sector undertakings. Public sector undertakings are first you have to write these 3 points, right? Next, what is the performance of public sector in India? They have made there are public sector undertakings, PSUs, which have made lot of profit, those which have made heavy losses. Both the things are there. But largely these things have made profit and they have given dividend. Dividend, Andre, what do you mean by dividend? Out of the profit, some amount is given to the government, that is called dividend. So what is the importance? What is the importance of public sector? See, if the economy is completely dependent on private sector, what happens? If the private sector fails, then that particular sector, suppose private sector is in telecom only private sector fails, so the entire telecom industry will collapse. So there should be some public sector, that is one thing. Next, private sector there will be monopoly. If there is private sector alone, there is monopoly. Public sector idre monopoly idreno. One person himself will control the entire business, right? So that is one thing. So that is the importance of public sector. Then importance, private sector is profit oriented. Public sector will think about the people, welfare oriented. That is the importance, right? Public sector forms the basic foundation of the economy. That is one more importance. So all these things are the importance of public sector in India. So today there are 244 central public sector enterprises. 244. There are many disinvestment happening. Many entities are disinvested. But today it remains 244. Right? So central. State level there are many public sector enterprises that we are not bothered about. Central. So yavadu public sector enterprises. So BHEL, BAL, HAL, HMT. All these things are NTPC, Coal India Limited. You name it. There are 244, right? Container Corporation of India, Food Corporation of India, ONGC, OAL, BPCL, HPCL. So BP is disinvested anyhow now. So you name the sectors. Yav sector alli ide. You name the sector, public sector and infrastructure alli ide. Oil sector alli ide. Food sector it is there. Yes, fertilizer sector it is there. Every sector, public sector enterprises is there. Energy sector it is there. So there are multiple sectors. What are the limitations of public sector? Limitations. One is there is no competition, bad work culture. See, to remove an employee in public sector, it is very, very difficult. You just take the example of SBI. Why those people behave such badly? SBI employees with the customers. Because to remove them, it is very difficult. Private sector, if some bank employees behave badly, if you just write one complaint, he will be fired immediately. So, the employee lethargy is one thing, one limitation, employee lethargy. The second limitation is they are not efficient. They are not efficient. That is the second thing. And they do not grow with time. Old processes itself will be there. That is the second thing. Next, third limitation is there is no proper management. Management is not efficient. That is the third thing, right? And also many public sector have gone into losses. Government has to pump in money into them again and again. That is there. So likewise, there are multiple limitations with respect to public sector in India. So public sector and economic reforms. 1991 public reforms adaga, what were the reforms with respect to public sector? The first and foremost reforms is the disinvestment. Maruti, MTNL, Sterlite India, all these things were under public sector. Maruti Udyog, Maruti Suzuki today, all of them were sold to private sector, right? So that is one thing, disinvestment. Second thing is foreign competition was allowed. Foreign competition was allowed. So these companies became, actually they wanted to compete in the market. Private sector was allowed. There was a challenge. So it ended the monopoly of public sector. So all these things are the reforms. I mean reforms with respect to economy. So new industrial policy 1991. New industrial policy 1991 gives the shows where the public sector stand, how they have to be reformed. New industrial policy 1991. So there are three areas of public sector which are reserved only to public sector, right? One is railways. Now it is also being privatized. Railways, next space exploration, and one more is atomic energy. These three areas only public sector is there. If other than this, you name any area, there is private sector. Railways, space and nuclear energy, atomic minerals, nuclear energy and atomic minerals. These three areas. Now there is disinvestment. Disinvestment andru onde, divestment andru onde. Yes, disinvestment, divestment. I have told you what is disinvestment. It means what? If a public sector company 100% is owned by the government, if they sell 30% of the share to some private enterprise, right? Then it is called, how much is remaining with the government? 70%. So it is 30% of the shares is divested, disinvestment happens. So up to 51% government the share idre, government owned company. If the share of the government falls below 49%, then it is private company. So if they sell 51% of the shares, 50% in the more shares na the government sells, then it is called strategic disinvestment. Strategic disinvestment, right? This is the concept. Strategic sale anta karitare. Yeah? Okay. Disinvestment and privatization. I told you what is disinvestment. So up to government owns 51% of the shares, it is disinvestment. More than 50% of the shares, if the government sells to private sector, it is privatization. Private sector starts owning the company, public sector enterprise now. So that is the difference between disinvestment and privatization. It is with respect to the percentage of share which is sold, right? Privatization is also called as strategic sale, right? Okay. Next, which are the companies? One is this IPCL anta ondittu, that was sold to Reliance Indian. It might be Indian Petro Corporation Limited or something. It was sold to Reliance Indian Limited. Balco was sold to Sterlite. So complete privatization happened here. Complete privatization. So that is one thing. So only private sector sale madbeka? No. there is one public sector. Say, let us say there is one A, public sector A, PSC A. PSC A is there. So if you want to sell B, instead of selling it to private sector, you can sell it to one another public sector. That is cross holding. Cross holding. Strategic sale to other PSUs. Other PSUs, there are many PSUs which are making thousands of crores of profit. They can buy this loss making public sector enterprises. So what are the advantages? What are the advantages of the disinvestment? One is it brings in finances. It improves the finance. See, 30% share if the government sells, government gets 30%, that 30% money, right? So it brings in more finance to the government. That is one thing. Next is it brings in market discipline. So public sector, private sector, na if you bring in the public sector, there will be efficient. They will make it profit oriented. There will be discipline in the functioning. Prices, ಏನಾರ ಒಂದು ಪ್ರಾಡಕ್ಟ್ ನ ಸೇಲ್ ಮಾಡಿದ್ರೆ, the prices will be so set and the quality will be so maintained in order to attract the market. So there will be market discipline in the public sector. That is one advantage, right? And also professionalized. These private sector managers will come into public sector by disinvestment and strategic sale. So professionalize agutte public sector. Then wealth distribution. Wealth distribution andre, see, the sale of the shares in the public sector will give some money, fetch some money to government, right? That money can be invested in the social sector, health and education. So money gets from rich people. Private sector yaar buy ಮಾಡ್ತಾರೆ ಅವರಿಂದ ದುಡ್ಡು will go to poor people. Wealth distribution happens. Then it increases the market depth. So LIC is proposed to be divested, disinvestment ಮಾಡಬೇಕು, some 5 or 10% of the shares, right? So it increases market depth. Market will, so there is market, this market will go into multiple areas, including the private sector. So market depth will increase. Then it increases economic activity. See, earlier a public sector enterprise is there. They will set, just let's say Maruti Udyog was a private public sector enterprise. They will set a goal of manufacturing just 200 cars per year. So iವರು private sector ಅಲ್ಲಿ ಬಂದ್ರೆ what they do, they will increase the target to 2000 cars per year. So it increases the economic activity. Then it reduces the public debt. See, fiscal deficit andre fiscal, you know the concept of fiscal deficit, right? So with disinvestment happens, what happens? The money, the private sector money who are going to buy, the money is going to come to the public sector, right? So that public sector can, that money which comes by sale of shares can be used for curbing the fiscal deficit or curbing the public debt. That is one advantage. Then it increases the choices. It increases the choices. See, earlier there was only BSNL. Now there are so many companies. Isn't the choices increased among the public? There are multiple companies. So choices are increased. What are the criticism of disinvestment? See, the criticism is, first is selling the family silver. See, these are like built with lot of sweat, public sector enterprises. The independence admele, there was so much effort to build these public sector enterprises, right? So it is like, if you sell the public sector enterprise, it will give you some money, but it is like selling the family gold. Family gold na sell madang. It is like, you know the golden hen story, right? Golden goose. Or instead of keeping the goose and taking golden egg every one day, he will kill. So it is, disinvestment is just like that, killing the public enterprises at once. That is one thing. Next, public sector enterprises is required to check the private enterprise, because private enterprise can make cartelization. Cartelization is every one of them can come together and raise the prices. So in order to check the rise in prices, check the private sector, public sector is needed. That is one thing. Then this public sector gives dividends to the government. Time to time they are going to give profit to the government, right? Dividend, if you sell the public sector, the dividend coming, the dividend profit will be lost. That is one thing. Then revenue deficit. If you sell the public, see, whatever the dividend they give, it will help curb the revenue deficit. The money, whatever the shortage in money which the government faces every year, this public sector profit can help to reduce it. So these are the disadvantages. Okay. Next, we will focus upon valuation of shares. See, suppose now the government is adamant on selling the public sector. So how the shares are valuated? How do you calculate the value of the public sector? See, the value is calculated based on the discounted cash flow model. The public sector is valued on discounted cash flow model. What is discounted cash flow model? See, it depends on the cash flow not only now. See, it means you are selling a public sector enterprise. You are selling a public sector enterprise. The buyer is not going to look at the cash flow now. Iವಾಗ ದುಡ್ಡು ಎಷ್ಟು ಬರ್ತಾ ಇದೆ is not only concerned only on that, but futurely what is the cash that is going to flow? Futurely in this public sector enterprise, what profit it is going to make? How much money it is going to make futurely? That is the concept of discounted cash flow. That is, shares were valued not only on today's value, but also on the future growth potential melo shares are valued. This is discounted cash flow model, right? Next, what is the government policy on disinvestment? Government policy. One is to raise money. To raise money. Government needs money, they are going to raise money by disinvestment. That is one thing. Next, to SEBI mandate is there. Security Exchange Board of India. So recently, a new woman chairman, first woman chairman, Madhavi Puri. It is expected in your low level exams, that is the state level exams. UPSC is not going to ask all those things. Madhavi Puri became the chairman of SEBI, right? Please remember the name. It is not Madhavi, it is Madhavi. So Madhavi, I think she is from West Bengal. So in Bengal, Vidya they pronounce as Vidya. V they pronounce as B. So I suspect she is from West Bengal. I am not sure. Yes. So SEBI mandate is there. SEBI mandate. What is the SEBI mandate? To disinvest. So or to disinvest from the public sector. That mandate is there. Also, there is a SEBI mandate to convert the public sector into shares. Public sector value enide, money value, that should be converted into shares. That mandate is there with the SEBI, is given by SEBI. Then also, why disinvestment? Many public sector enterprises are making loss. In order to revive those companies, instill, re-energize those companies, we need disinvestment, and also to close down the bad companies. In order to close down the bad public sector, the companies, we need this disinvestment. Then also to protect the interest of workers. Right? So workers may not be paid properly, right? Workers' interest should also be protected while disinvestment is done. So workers, you cannot fire them directly when a company is disinvested. So there has to be proper safeguard. They should be, if the disinvestment happens and the company goes into private sector, they have to be rehabilitated. They have to be re-skilled, right? So workers' interest should be protected. This is the thing. And also not only SEBI mandate, Niti Aayog also says that there should be disinvestment. The mantra that is given by the government is, business is not the business of the government. Business madodu government business alla. That is the mantra of government under which the disinvestment is carried out. Next, strategic and non-strategic classification. What are the strategic? Strategic andre arms, atomic energy and railway. These are the strategic sectors today. So also current affairs recently 2022 or 1 year back, our finance minister Nirmala Sitharaman ji said that apart from 4 sectors, 4 important sectors bitre ella kade private investment is allowed. Apart from 4 PSEs, I told you 244 PSEs. Just apart from 4 PSEs, rest 240 sectors alli, 240 PSEs, wherever the sector, whichever the sector they are functioning, their private investment is allowed anta there is a current affairs news, right? That is one thing. So arms, atomic energy and railway are called strategic, other things are called not strategic. Strategic means what? See, government strategy. So nation strategy is based on this. Nation strategy. One deshada strategy, arms. If you give it into private sector, it will be harmful. Atomic energy, private sector, it will be harmful. Railways, anyhow, they are privatizing, but it is strategic sector. Country's economic strategy is based on railways, right? And also economic social strategy also. So these are the strategic and non-strategic classification. Next, buyback of shares. See, there is a concept of buyback of shares. It is not only in the private public sector, also in the private sector. Buyback. Buyback means what? See, government would have sold the shares. Government would have sold the shares to private enterprises. So, government or any company would have sold the shares to public or private enterprise. So, what they do, they are going to buy that shares back. Why do they buy the shares back? What are the advantages of buying the shares? One is exit route. See, some shareholders, they don't want to remain in the company. Remain in the company to provide them exit route, to provide them an exit route so that they exit from the company. This buyback of shares is done. That is first thing. Next, consolidation. Andre, consolidation means, see, by selling the shares to multiple stakeholders, what happens? Actually, the ownership is divided. So, to consolidate the ownership, to consolidate the public sector enterprise, buyback of shares is done. That is the second thing. Next is surplus cash. Surplus cash. So, suppose a public sector makes lot of profit they make. They want to invest that profit, surplus cash, into some business or into the same business. They want to invest it in the same business. So then they are going to buy back the shares. Next, support share price. So this point is important. What is support share price? See, let's say the share of a public sector enterprise is, one share is 10 rupees. So by investing the cash, the same public sector enterprise, let's say A, public sector enterprise, A, one share price is 10 rupees. But this has excess cash. So they are going to buy their own shares from the market, which is divested. So when they buy their own share market, the demand of the share increases. When the demand of the share increases, the price of the share increases. So to support the share price also, buyback is done. It is a strategic decision. Next, you have the concept of cross holdings. Cross holdings means simple. Public sector A will invest in public sector B, public sector B will take the shares in public sector C will take the shares in A. So the shares are divided among themselves, not with the private sector. That is the concept of cross holding. Next, you have public sector enterprises exchange traded fund, ETF. What is this ETF? See, ETF is just like a mutual fund. I have told you mutual fund and Renu anta. What do you mean by mutual fund? I have told you already. See, what happens? It is one investor, one company, single investment, multiple investors, multiple company via a fund is mutual fund. Simple as that. So, illi multiple investors with respect to, see, ETF means it is a mutual fund, as simple as that. So, ETF, exchange traded fund, alli mutual fund. So, how many companies are there? 10 public sector enterprises. 10 public sector enterprises are there in the mutual fund, which is called as exchange traded fund. 10 public sector companies do share ide this exchange traded fund alli. This will be given to sold in the share market to multiple investors, this mutual fund. So this is the concept of exchange traded fund. Next you have the concept of VIRAT 22. The name itself suggests it is a ETF, exchange, it is a mutual fund, ETF. But instead of 10, there is 22 public sector enterprises to shares ide in VIRAT 22, right? So this was given in 2017. 22 stocks are there, 22 company stocks are there in VIRAT ETF, right? So this is managed by this organization called this mutual fund, ETF. Now who manages it? See, 10 public enterprises shares now kottpudtare. Somebody has to manage it, right? Somebody has to take that shares, list it in the, create a mutual fund and list it in the stock market. So which organization does it? It is the SUTI organization, Strategic Holding of Specialist Undertaking of Unit Trust of India. So the name is too big. You just remember it is Specified Undertaking of Unit Trust of India, SUTI, SUUTI. SUTI manages it, right? So it holds the strategic holding. Strategies kya hai? It holds the government funds or the public sector enterprises shares na it is holding, that is it is a strategic holding and the name is Specific Undertaking of Unit Trust of India, right? Okay. Next you have methods of disinvestment of minority stake in CPSC. Central public sector enterprises alli how you are going to divest the money. How you are going to divest the money in the central public sector enterprise. See, methods of disinvestment of minority stake in central public sector enterprise. How you are going to divest. One is IPO, initial public offering. I told you what is initial public offering, stock market chapter alli. When a company which is going to first time into the stock market, they are going to issue shares in the name of IPO, initial public offering, right? Next you have FPO, follow on public offer. First IPO kottirtare, that will be started trading in the stock market. Later on, they want to increase they want to give some more shares in the company, that is called follow on public offer, Next you have strategic sale. Strategic sale is selling more than 50% of ownership. More government sells more than 50% of its shares in a public sector enterprise, then it is called strategic sale, right? Oh, sorry, I forgot this OFS. Offer for sale. OFS. Offer for sale. What is offer for sale? It is also a FPO. Follow on public offer. Adu kuda offer for sale andre. It is a FPO. So, illeno follow on public offer. Some shares are offered for sale. That is offer for sale. OFS. So, strategic sale I have also told you. And also how do you disinvest? By CPSC ETF and also by cross holding. These are the 6 methods how disinvestment in the central public sector undertakings can be done. Disinvestment agutte. How this disinvestment how this disinvestment money would be used? How this disinvestment money would be used? Yes, so it is actually used in the all this disinvestment money go to this fund, National Investment Fund. Ene disinvestment adru yavade public sector enterprise, all the money goes to National Investment Fund. Yeah. Where is this National Investment Fund saved? It is saved in the public accounts of India. National Investment Fund is saved in the public accounts of India, right? I have told you public account, consolidated fund, contingency fund, public account of India. So all this ನ್ಯಾಷನಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಫಂಡ್ ಅಂತ ಇದೆ. ಆ ಫಂಡ್ ಅಲ್ಲಿ ಎಲ್ಲಾ ದುಡ್ಡು ಡಿಸ್ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಇಲ್ಲೋಗಿ ಸೇವ್ ಆಗುತ್ತೆ. ಈ ಫಂಡ್ ಎಲ್ಲಿರುತ್ತೆ? ಪಬ್ಲಿಕ್ ಅಕೌಂಟ್ ಆಫ್ ಇಂಡಿಯಾ ಅಲ್ಲಿ ಇರುತ್ತೆ, ರೈಟ್? ಸೊ ನೆಕ್ಸ್ಟ್ subscribing shares, preferential allotment of shares and recapitalization. What is subscribing shares? Some disinvestment ಮಾಡಿದಾಗ private companies will come and subscribe for the shares, that is subscribing shares. Then is preferential allotment. Preferential allotment andre some people they will preferentially allot the shares. See, suppose one public sector share na some other public sector is coming and buying, that is cross holding. For them there is preferential allotment of shares. Common public ಗಿಂತ ಅವ್ರನ್ನ ಪ್ರಿಫರ್ ಮಾಡ್ತಾರೆ, that is one thing. Next is recapitalization. Public sector na they can recapitalize it, put more money in the public sector if it is going into losses. You know why recapitalization? In order to increase the share price, right? That is one thing. Next, investment by government. Investment by government. So see, idralli what all the monies which is going to saved in the national investment fund anta. Share subscription money nu ille hog save agutte. Preference amele recapitalization money and also investment by government. Any investment by the government in the public sector enterprise, that will also go and save there. And equity infusion. Equity infusion. Equity infusion means what? Buying more shares. Buying more shares in the public sector enterprise, right? This is how the use of disinvestment proceedings, andre disinvestment ಮಾಡಿದ money na how they are going to utilize that money. It can be used to subscribe more shares, one. It can be used to allot shares to someone, two. It can be used for recapitalization of the public sector enterprise itself or the banks, three. Or it can be used for some investment by the government, four. And also it can be used for equity infusion, buying more equity somewhere in some company, right? So this is how the disinvestment proceedings are used. Next you have DIPAM, Department of Investment and Public Asset Management. It is a department. DIPAM, Department of, so ಈ ಹೆಸರನ್ನ ಕೊಡೋದು 2016 ಅಲ್ಲಿ. 2016 this name is given DIPAM, Department of Investment and Public Asset Management. Disinvestment is carried out by this department. Who carries out the disinvestment in the idandre this department carries out the disinvestment in India, right? So what do they do? Manage the central government investment in equity. Manage the central government investment in equity. Andre public sector enterprises ali government would have invested the money, right? So that money is managed, that equity, the shares of the government in the public sector enterprise is managed by DIPAM. Then also strategic disinvestment, selling the public sector enterprise completely to the private enterprise, that is strategic sale, is also managed by DIPAM. And also dividends, how much profit, if the public sector makes profit, how much profit is given to the government, that is also managed by DIPAM. Then financial restructuring, if a public sector enterprise is making losses, they have to financially restructure it. How do you financially restructure it? Pump in more money or bring in new management, install new machines. So financial restructuring is also done by DIPAM, and also it attracts investment for the public sector enterprise. Private investment, see if you want to sell the shares, who is going to buy the share? In the public. So public sector enterprise, it is the private sector. So in order to attract the investment, this DIPAM will also carries out the work. Next you have the concept of Maharatna, Navaratna and Mini Ratna companies. Very very important. Maharatna, Navaratna and Mini Ratna companies, right? So you have first Maharatnas. So this is very important from your low level or high level examination perspective. So this Maharatna status was given in 2010. Maharatna company status anta, it was given in 2010, starts in 2010. Why? Why this Maharatna? See, when you give a public sector enterprise, see what are the companies in Maharatna written here? BHEL, Bharat Heavy Electronics Limited, BPCL, Gas. There are only 10 central public sector enterprises. Maharatna estide only 10. What are they? BHEL, BPCL, Gas India Limited, HPCL, Indian Oil Corporation, NTPC, ONGC. Some 3 more are there. 10 CPSCs. So Maharatna 10 al kodtare. When they give the Maharatna status to a public sector enterprises, what happens? It gives that public sector enterprises more power. ಈಗ suppose BHEL ಗೆ Maharatna status kotre, the power of BHEL will increase. It becomes more independent. Government mele dependency kadme agutte. It will become more freedom. It will have more autonomy. So that is one thing, enhanced power, and they can carry out the expansion. Andre one public sector idre, if it has to expand, if it has to buy more land, if it wants to set up subsidiary, if it wants to set up some a new entity somewhere else, earlier they have to take the permission of the government, but expansion, if you have a Maharatna status, you need not ask the government. That is one thing. Then investment, Maharatna status ke what should be investment? It is actually 5,000 crores. 5,000 crores is the investment in the Maharatna company. 5,000 crores, right? Investment in the Maharatna company. So Maharatna anta consider agbekane, there should be 5,000 crore investment is there. Next, eligibility. Yav company na, which public sector enterprises will be called as Maharatna? There should be Navaratna status. I am going to discuss what is Navaratna. Navaratna status irbeku, then that company should be listed. Stock exchange ali it should be listed. Right? That is the second thing. Then turnover. Annual turnover 25,000 crores should be there. Annual turnover of that company should be 25,000 crores. Next, net worth. Net worth of the company should be 15,000 crores. Net worth andre eno? Bele, a company bele, ottu bele should be 15,000 crores. And net profit, yearly profit should be 5,000 crores. Yeah, 5,000 crores should be the profit. Investment, I told you the investment. See, when you have a Maharatna status, up to 5,000 crore you can invest. Andre, Maharatna company, suppose you have IOC, Indian Oil Corporation. If it wants to invest some money somewhere, andre Saudi Arabia oil pump sikkide, this IOC has to go and invest there. So Maharatna status idre up to 5,000 crores they can invest without asking the permission of the government, right? So that is one thing. Then Maharatna status idralli actually these companies have global presence. World over the presence is there for these companies. So this is about Maharatna. Next you have Navaratna. See, Navaratna is older than Maharatna. Navaratna, it is second level. To 1997 ali it is formed. This status is given. Why in 1997? Because LPG, 1991. LPG happens. Liberalization, privatization and globalization. That is when, in order to strengthen the public sector enterprises. See, after 1991, many foreign companies will come to India. And also, local companies, local private companies will also grow. So, for these public sector enterprises, there will be lot of competition. Earlier they were monopoly or adidata. Now, there will be lot of competition for them. Lot of competition, external and internal. So, in competition iddaga, if they are under government control, it is not able to perform well. Because one file move agbekane, it has to come from Delhi. So, they give Navaratna status. Navaratna status kotti, they will free them. Their autonomy. They need not ask government for anything by giving the Navaratna status, right? So it is given autonomy for performance. They are given autonomy to increase the performance, right? Next, they can decide the capital expenditure. Navaratna status idre up to a certain, see, for Maharatna it is 5,000 crore. For Navaratna there is some lesser limit. up to that limit they can invest in invest the capital. They need not ask the government. That is one thing. Then they can set up joint ventures. Andre, without asking the permission of the government, they can set up joint ventures with some other company, private company or a public company. That is one thing. They can set up subsidiaries, andre child organization, children organizations. See, there is Reliance, Dhirubhai Ambani Company Limited. So Jio is one subsidiary of Reliance. Likewise, if HAL is a Navaratna, HAL can set up subsidiaries, right? And also it can have alliances, strategic alliances can be there. Alliances with either public sector or private sector can be there. That is one thing. And also it can raise the funds. It can raise the funds without asking the government. Fundraising could be carried out, right? That is one thing. So these are the benefits of having a Navaratna status. What is the eligibility? Eligibility of getting a Navaratna status. Navaratna status irbekare, what should be the eligibility? One, it should be profit making. The public sector enterprises should be profit making. Then there should be some minimum net worth. Ishtu anta minimum net worth irbeku. Then only, and also there should be manpower cost. Manpower cost should be less. Manpower, and the human resource cost should be less. That is one thing. Next, turnover should be good. Turnover should be good, and there should be share price should be high. Stock market share price should be high. Then also performance. There should this public Navaratna should actually perform well. There should be good performance. That is one thing. Then it should have a mini Ratna status. See, Maharatna agbekare there should be Navaratna status. Navaratna stay agbekare there should be mini Ratna status. Right? Next. So it is two mele. So these many conditions from here to here, these are the conditions to be eligible for Navaratna. So out of these conditions, there is a score of 100. So out of all these conditions, if they score 60 out of 100, out of all these conditions, if they score 60 score out of 100, then they are eligible for Navaratna. Then they are eligible for Navaratna, right? Okay. So 60 out of 100 score should be there, right? Okay. Next, there are 14 Navaratna companies. How many Navaratna companies are there? There are 14 Navaratna. So some of the examples I have brought here. That is BEL, Bharat Electronics Limited. Your electronic voting machine, EVM. It is actually manufactured by BEL, right? HAL, MTNL, Mahanagar Telecom Nigam Limited, OL, Oil India Limited, yes, IOC, this is different, this is different, and PFCL, Power Finance Corporation Limited. All these things are Navaratnas, right? Next you have Mini Ratnas. So Mini Ratna, what are the benefits of having a Mini Ratna status? They can decide joint ventures. Just like Navaratna, they can decide joint ventures. They can also set up subsidiary. They can also set up subsidiaries. Autonomy for PSCs. Autonomy, independence for this public sector enterprises. What are the autonomy for public sector enterprises? One is managerial autonomy. And the management should be independent. If management mele, if the government is going to sit, they cannot function independently, right? So there should be managerial autonomy. That is one thing. Then there should be financial autonomy. Finance, they should not depend on the government. They should be able to generate their own finances, right? So there should be financial autonomy. Then autonomy and the independence. Then how autonomy is given? One is Maharatna, Navaratna and Mini Ratna. By giving Maharatna, Navaratna and Mini Ratna status, then autonomy is given by disinvestment. If you disinvest the shares, private sector is going to come. Private sector management will come. So by that, autonomy is given. Private sector and it will be independent of the government. Via these two, and also there are many ways of giving autonomy. These two I have mentioned. There are many ways. One more way is signing a MOU, Memorandum of Understanding. I will discuss what it is. Then professionalization of BPSU board. Public sector undertaking board irutala, that board should be professionalized. That is one thing. So out of all these areas, the independence of public sector enterprises can be ensured. So what is the professionalization of PSU board? Professionalization of public sector undertaking board andre professional should be hired. See, BL is an electronics company. What is the use if you put some IAS officer there? Some electric engineer should come there in the board who knows about electronics and electricals, right? So that is professionalization. Professionalization of the board, outside professionals, not from government, from outside professionals should be brought in. That is one thing. Then professionalization MNM, that is according to Maharatna, Navaratna, Mini Ratna status, professionalization is carried out how 4 non-official directors should be there. There are generally official directors, alva. 4 non-official directors should be there. That is one thing. Next, only 2 government directors. So this is how the PSU board is professionalized. Public sector undertaking board is professionalized. Next, you have MOU, last concept of the day, Memorandum of Understanding. So what is this Memorandum of Understanding? Andre, see, government is going to sign an MOU, agreement with the public sector undertaking. Enanta, see, earlier there was no good performance in the public sector undertaking. So they sign an MOU saying that you have to produce this much goods with this much quality in this much time. They are going to give target according to the MOU. MOU sign madmele, they have to achieve the goal, right? So MOU concept was given by Arjun Sen Gupta committee. Whenever public sector enterprise anta bandre, this person's name is important. Arjun Sen Gupta committee. So it is a performance commitment. Andre, performance. Suppose BL, Bharat, I am going to produce these many EVMs with this quality in this much time. Right? So they are going to, according to MOU, they are going to give performance commitment. Iste performance kodtivi. Right? So that is performance commitment. When according to MOU, if they increase the performance jasti adange, autonomy would be increased. If you give good performance, government will give you freedom. You can manage work on your own. Government will not interfere. This is with respect to the Memorandum of Understanding concept. We will end the class here. We will catch up again tomorrow. So please make good use of the classes. If you have any doubts, please put it in the comment section and also on our Telegram channel. Wish you all the best. Please take care of your health. Jai Hind. Namaste.